Good evening, friends. Today we are going to discuss Ind AS 34, right? So Ind AS 34 deals with the interim financial reporting. So before starting this standard, I will just give you a brief background about the standard Ind AS 34. So this standard does not actually deals with the full financial reporting. This standards only deals with the interim financial reporting. Now the question arises, what is interim financial reporting? So standard says the interim financial reporting is that reporting where the period of the reporting is less than 1 year. That means where the month of the reporting is not 12 months, is less than 12 months. It may be on a quarterly basis, it may be on 6 month basis, it may be on the 9 month basis, but it is less than 12 months. So that is what the interim financial reporting is. Right, guys? So in respect of the interim financial reporting, we are going to discuss how do we need to recognize assets in my books of accounts, how do we need to recognize liabilities in my books of accounts, how do we need to recognize revenue and expenses in my books of account. My means in respect of the particular company, right? So how a company will recognize expenses, revenue, liabilities, assets when the company is preparing its interim financial reporting and not the full-fledged Ind AS accounts. So how the company will record, what are the measurement principles, what are the recognition guidance which the company has to follow, right? So this is the brief background about this standard, guys, right? So with this brief background, let's start the standard Ind AS 34 interim financial reporting, right? So first is the objective part, why we are reading the standard, right? Why we are reading this standard, what is the objective of Ind AS 34, right? First of all, it provides the minimum guidance. It provides a minimum requirement of content for interim financial reporting. Interim financial reporting, right? Second point, or I would say this is A, this is B, right? Second point, it provides the principle. It provides the principle for recognition and measurement in interim financial reporting, right? This is the objective which we are having, and where we are saying that there should be a minimum requirement of content for the interim financial reporting. What are the principles? What are the principles which needs to be there while preparing, while in respect of the recognition and measurement in respect of the interim financial reporting, right, guys? So this standard does not provide any guidance that to which entity it is applicable, to which entity it is applicable, right? And how often interim financial reporting is required, right? This is also called interim financial reporting, IFC, right? Interim financial IFR. Interim financial reporting is required. So this standard does not provide us the guidance that to which company it is applicable, right? So that means company has to choose whether they have to prepare the interim financial reporting or not, right? It does not provide any guidance to which it is applicable. It also does not provide any guidance that how often the company has to prepare its interim financial report, right, guys? Now the question arises, what is interim financial reporting? Definition, I would say. Definition: interim financial reporting. Interim financial reporting is that reporting where the period is less than 12 months. Where the period is less than 12 months, right? This is interim financial reporting. Interim period, I would say, interim financial period, right? Now the question is, what is interim financial reporting? What is interim financial reporting? Interim financial reporting can be a condensed financial reporting, or or full financial reporting, right? So interim financial period is that period where the period is less than 12 months. That means it is not for the annual period, it is less than 12 months. But what is interim financial reporting? It is a condensed set of the financial reporting, or the full-fledged of the financial reporting. Both is acceptable. So sir, when we will prepare the interim financial reporting, what all statement needs to be prepared? That means, what are the different forms? What are the different statements for interim financial reporting? First, balance sheet. We need to prepare balance sheet. Second, we need to prepare profit and loss. Third, we need to prepare comprehensive report, or I would say this is a other comprehensive income. Fourth is statement of cash flows. Correct. Fifth is statement of changes in equity, right? And the sixth point is significant changes in accounting policies, estimates, and judgments, right? If there is any significant accounting policies, estimates, and judgment, that needs to be disclosed, right? And seventh point is any significant transaction which has occurred during the particular period, that also need to be disclosed, right guys? So let's devote 2 minutes here. So what is the objective? Objective is, what is the minimum requirement of the content which needs to be presented in the interim financial reporting? Second is, we need to understand the principle of recognition and measurement of assets, of liabilities, of income, of expenses, which needs to be disclosed, and how these assets, liabilities, expenses, income needs to be recognized in the financial reporting for the in case of the interim financial reporting. That guidance will be provided by Ind AS 34, right? Second point, this standard does not provide any guidance This standard does not provide any guidance that to which entity it is applicable. Generally, practically what happens, all the listed companies have to present their financial statement on a quarterly basis, right? So those listed companies will follow Ind AS 34. So whenever they present their financial statement, that financial statement needs to be audited either by auditor, or it needs to be limited reviewed by the auditor, right? But they have to prepare their interim financial reporting, or they have to prepare their quarterly financial reports as per the requirement of Ind AS 34. So that means if they are preparing their financial statement for the interim reporting perspective, they have to follow Ind AS 34 guidance. Otherwise, that financial statement is not in compliance with Ind AS 34. Right, guys? But Ind AS 34 does not prescribe any guidance that to which entity it is applicable. But if an entity is preparing interim financial reporting or interim financial statement, then they have to apply Ind AS 34 for the perspective of preparation of interim financial statement. Right? Simple. What else? It also does not provide the guidance of how often the interim financial reporting is required. What is interim period? Interim financial period is any period which is less than 12 months is called interim period. What is interim financial reporting? Interim financial reporting can be a condensed financial reporting. What is a condensed financial statement? Condensed financial statement means a short financial statement. What is condensed financial statement? Short version of full financial statement. It is a short version of the full financial statement. Right, guys? It is a short version of the full financial statement, or the company can prepare the full financial statement for that particular period, right? What are the different statements which needs to be incorporated, which needs to be presented when the company is preparing interim financial reporting? First is balance sheet, right? Second one is the profit and loss account. Third one is the other comprehensive income, statement of cash flows, statement of changes in equity, significant changes in the accounting estimates, accounting policies, and judgment. So company is not supposed to give the detailed accounting policies in the condensed financial statement, right? In the condensed financial statement, in the condensed financial statement, company is not required to give the detailed accounting policies, detailed estimates and judgment. They are supposed to give the significant change which has come up because of the change in the accounting policies, right? And if any significant transaction has occurred during the particular period, right, during the particular interim financial reporting period, then that significant transaction needs to be disclosed. We need to understand what is that significant transaction, right? We need to understand what is that significant transaction. Let me rub this. Let me rub this. I hope this is clear to you. Okay. Okay, guys. This is fourth point. This is fifth point. Significant transaction. Right? What is the significant transaction which the company needs to disclose? For example, business combination. For example, business combination, acquisition, merger, demerger, common control transaction, etc. Right? Impairment. Impairment of any financial assets. right? Impairment of any non-financial asset, that needs to be disclosed separately, right? What else? Acquisition, disposition, disposal of PPE or intangible, right? What else? Significant inventory write down. Significant inventory write down, that needs to be disclosed separately. What else? What else? Reversal of provision for inventory write down. Correct. What else? Litigations. Litigation. For example, income tax, GST, etc. Contingent liability, right? Contingent liability. Significant bad debt, right? What else? Business combination, impairment of any financial asset, impairment of any non-financial asset, PPEs, inventory write down, provision for inventory, litigation, contingent liability. What else? Material prior period, right? So these are the illustrative list which is provided in the standard, right guys? So let's go one by one. So if let's say there is a business combination which the company has done during the during a particular period, business combination, what do you mean by business combination? So there is a respective standard or a separate standard, Ind AS 103, which deals with the business combination, which says there should be an input, there should be process, and there should be an output, right? So if that company, if that acquisition satisfied the criteria of business combination, then the transaction needs to be accounted as per Ind AS 103, right? And Ind AS 103 provide two guidance. One is the what are the different approaches due to which the transaction needs to be accounted for. One approach is purchase method or acquisition method, and second approach is common control transaction. If the company has taken, if the company has purchased, or if the company has entered into the transaction with a third party, with a third party means it's not a related party, it's not a within the group, right? Then that transaction needs to be accounted at a fair value. That means company will recognize the asset, company will recognize the liability at fair value, and there will be a purchase consideration which needs to be determined at fair value itself. It may possible that it will result into a goodwill or a reserve. Or that reserve is called bargain purchase gain under Ind AS 103. So if that kind of transaction happen, the company need to give a disclosure in its interim financial reporting what kind of transaction company has entered into. But if it is in the nature of common control transaction, what is common control? The common control means the transaction which has happened within the entire, within the group of the company, right? That is a common control. In case of common control, the accounting will be governed by again 103, and it says that the accounting is in the form of book value accounting. It's not a fair value accounting, right guys? So that is a business combination. So if there is any business combination, acquisition, merger, demerger, right, that will be account that will be accounted or that will be disclosed in the interim financial reporting, right? What else we are having? Impairment of the financial asset. What is financial asset? It is governed by Ind AS 109. It is governed by Ind AS 32. What is financial asset? Any contract which has been entered between two or more parties which give rise to a financial asset of one entity and a financial liability of another entity is called financial instrument, right? What can be the example? Trade receivable, security deposit receivable, right? If I've given any loan which is refundable in cash or bank, that is a financial asset. Investment in debenture, investment in bonds, those are financial asset. So if there is an investment in the financial asset and there is an impairment, then that disclosure needs to be made in the financial or in the interim financial statement itself, right? Impairment of the non-financial asset. What is non-financial asset? Impairment of, let's say, PPE, impairment of, let's say, intangible assets. These are non-financial asset. So if there is any impairment that is a significant impact in the company, that needs to be disclosed separately in the interim financial statement. Acquisition, disposal of PP. If there is an acquisition of PP, which is a significant acquisition, if there is a disposal of PP during the particular period, that needs to be disclosed in the financial statement. What else? Significant inventory write down. If the company has incurred a significant inventory write down, that needs to be disclosed that needs to be disclosed in the interim financial reporting itself, right? Then we have the reversal of provision for inventory write down. If the provision of inventory which has been created by the company in the previous quarter, now in this quarter the company is reversing that provision, that again needs to be considered as a significant transaction that needs to be disclosed separately, right? Litigation. If the company has received the notice from the income tax authority, if the company is dealing with the income tax authority in respect of the couple of assessment, if the company has received a couple of assessment orders, those are called litigation. Those are needs to be disclosed in the interim financial reporting, right, guys? What else? Contingent liability. If there is any contingent liability, that needs to be disclosed. What can be the form of contingent liability, right? It can be in the form of arguments or the suit filed by a debtor on the company, suit filed by the vendor on the company, right? What else? If the company has given any guarantee on behalf of someone else, that is considered to be a contingent liability that needs to be disclosed. If there is a significant bad debt during a particular period, that also needs to be disclosed significantly. And if while preparing the financial statement of the particular interim financial reporting, if the company has found any material prior period error, that the material prior period error needs to be disclosed and that needs to be restated in the comparative period itself. That means to the period to which it pertains, right? And if it pertains to the period prior to the opening of the comparative period, then we need to restate the opening of the comparative period. We need to apply Ind AS 8 on in case the prior period error found by the company itself, right, guys? So these are the significant transactions which I mentioned on the board, which needs to be taken care by the company itself, right? Right, guys? Okay. What else? What else? Let's understand. What else? Let me rub this side. So we were also talking about the form and the content, right? We were also talking about the form and content. Content of interim financial reporting. I hope this side is properly visible. Okay. So there are the three cases. There are three cases actually. What are these three cases? If the entity presents full annual financial statements, right? If the entity presents full annual financial statement, if the entity presents standalone plus consolidated financial statement, and the third case is first, this is or, and this is again or, this is second, and this is third. If the entity presents condensed financial statement. So these are the three scenarios which can be possible, where the company or the entity present the full annual financial statement, where the company present the standalone and the consolidated financial statement, and where the company presents the condensed financial statement. So what will happen in this case? So if the company presents the annual financial statement in case of the interim financial reporting, then the company has to follow the requirement of Ind AS 1. Right? If the company present the standalone and the consolidated financial statement in the interim financial period, then again the company has to follow Ind AS 1 criteria, right? This is not a mandate actually, not mandatory, right? Not required actually, right? If the company present the condensed financial statement, then the company has to follow the same heading. The company has to follow same heading and total which the company used in previous annual reporting. Right, guys? So there are the three forms. If the company presents annual financial statement in case of, if the company present full set of, full, not annual, full set, I would say full set of financial statement, right? In the interim financial statement, then they have to follow Ind AS 1. If the company present the standalone and the consolidated financial statement in the interim financial reporting, then it is actually not required. But if the company present, they have to follow again Ind AS 1. And if the company presents condensed financial statement, they have to follow the same heading, the same totality which they have used in the presentation in the recent annual financial statement, right? So these are the different forms which the company can adopt while doing the interim financial reporting, right, guys? Okay, what else? What else? Let me project my screen and let's discuss couple of more aspects in respect of the recognition and measurement. Let me project my screen. Okay. Okay, guys. Now the next topic is the recognition and measurement. What do you mean by the recognition and what do you mean by the measurement, right? So when we are saying recognition and measurement, we are talking about the revenue, we are talking about the expenses, we are talking about the assets, we are talking about the liabilities. That means when the company presents the interim financial reporting, that at what value they have to recognize the asset, at what value they have to recognize the liability, at what value they have to recognize the revenue and expenses, right? Whether they have the right to defer their revenue and expenses, whether they have the right to recognize a provision, whether they have the right to recognize a asset, right? So what are the different criteria in terms of recognition and measurement of assets, liabilities, revenue and expenses during the interim reporting period itself, right, guys? So let's understand, right? First point is, let me open the pointer as well, right? First point is same accounting policies. Same accounting policies as that of annual. That means when the company is presenting its interim financial reporting, right, the company has to use the same accounting policies which the company is going to use in its annual financial reporting. For example, let's say if the company is going to present its financial statement in 31st March 2021, right, and the interim period is June quarter ended June 2020. In that case, company has to adopt those policies which the company is going to follow, the accounting policies in the in the annual financial reporting period 31st March 2021, right? So the same accounting policy needs to be followed in the interim financial reporting which the company is expecting to use in the annual financial statement. Right, guys? So let's see what the standard is saying. Standard is saying the entity shall apply the same accounting policies in its interim financial statement as are applied in its annual financial statement. Right? Okay, what else? Principle for recognizing assets, liabilities, expense, income for the interim period are the same as in annual financial statement. Right? So what this is, what the guidance is saying, the principles of recording all the assets, liabilities, income and expenses will remain the same as the company has adopted in its annual financial statement. And what is the interim financial statement? Interim financial statement can be quarterly, half yearly, and annually as well. Right, guys. So in respect of the accounting policy, it shall remain the same which the company has already adopted in the previous annual financial statement. But if there is any change in the accounting policy, if there is any change in the accounting policy in that particular interim financial reporting, that needs to be disclosed as a part of the significant transaction that reporting. I give you an example. For example, till 31st March 2020, the company has adopted FIFO method of valuing the inventory. But when the company is reporting 30th June 2020, the company is changing its accounting policy from FIFO to weighted average. And this is a significant accounting change that needs to be disclosed separately as a part of the significant transaction. Right, guys? Okay. Revenue received cyclically, occasionally, or seasonally. So there may be a scenario where the revenue has been received by the company cyclically, occasionally, or seasonally. So in that case, what will happen? So standard says the revenue that are received seasonally, cyclically, occasionally within a financial year shall not be anticipated and shall not be deferred as of the interim date. So it is clearly saying that if the revenue is cyclical in nature, for example, what is cyclical in nature? For example, education industry, the company who is engaged in the business of developing the content and the books for any educational institution. For example, if the company is engaged in the business of developing the books for the school and colleges, right? For example, Eschan, right? So they are engaged in the business of developing the content and printing all the books, right? It's a seasonal business, it's a cyclical business, right? So what will happen? So company should not anticipate the revenue which the company is going to earn in the next quarter, right? That revenue should not be recorded in the previous quarter. For example, if I'm saying that the revenue for the September quarter, September 2020, should be around 100 crores, right? So I should not record that revenue in this quarter itself. That is what the seasonal and cyclical. So when we are saying the revenue, we need to follow Ind AS 115. Which method, which policies? We need to follow Ind AS 115 as we have adopted in the annual financial results, annual financial statement of March 2020. Right, guys? So that means though all the policies, all the revenue, all the policies need to be followed the same practice which we have adopted in the previous annual financial statement. Okay, let's move on. Cost incurred unevenly during the year. If there is any cost incurred unevenly during the year, right? For example, 30th June 2020 quarter, I have not incurred any cost, but that cost is going to be incurred in September 2020 quarter. But After that, that cost is not going to be incurred. So that means in the entire particular year, only the September quarter is the quarter in which the certain cost is going to be incurred. So should I straight line that cost in the for the entire year or not? So standard says that the cost cannot be anticipated and record in the previous quarter. The cost needs to be recorded, the expense needs to be recorded in that particular period in which the cost or the expense has been incurred. So that expense should not be deferred to the next quarter. The cost should not be preponed to the previous quarter. The cost should be booked in that particular period in which it is actually incurred. Right? Use of estimates. So the company has to use the estimates for judging the various kind of parameters, right? For judging the various kind of parameters for the estimates. What are the estimates? Right? What are the estimates? Estimates can be recoverability of deferred tax, useful life of the PPE, recoverability of deferred tax, useful life of the PPE. What else? What else? Actuarial gain and loss. In case of actuarial gain and loss, there can be the estimates and judgments. For example, what will be the salary escalation rate, right? Mortality rate. These are the different estimates which the company needs to be considered, right? For example, tax rate, that is also an estimate which the company needs to consider. Okay. Let's take some example to understand how it impact, how the various expense, how the various revenue, how the assets and liability will impact in the different scenario, guys, right? Let's take an example. Okay. First is year-end bonus. Year-end bonus. So generally it happens in a company that the bonus will be provided to the employees once the year end, right? That means if the company follow 31st March year end, when the year comes to an end, only then the bonus will be provided based on the targets achieved by the respective employees, based on the target achieved by the company, right? Now the question is, if the company is closing 30th June 2020, right? So whether the company should accrue the bonus or not. So standard clearly says that company should recognize as a provision for bonus if there is a legal or the constructive obligation exists, right? What is the legal obligation? Legal obligation which is arising because of the judgment of an order, judgment or an order of the court. That is a legal obligation. What is constructive obligation? Constructive obligation means the obligation which has been created basis of the precedents, past precedents of the company. That if it is there that the company is every year company is giving a bonus to the employee, then it becomes a constructive obligation which the company needs to recognize it. So standard says if there is a legal or the constructive obligation exists on the company, then the company needs to create a provision for bonus, and of course the bonus amount should be estimated so that the amount can be computed, right? So that there is a proper reliable estimate for the bonus. And second point is there should be a constructive obligation or legal obligation, right? If that is there, the company should recognize a provision for bonus in the quarterly or the interim financial reporting period, right guys? Okay. What else? Vacations, holiday, short-term compensated absence. So if there is any vacation, if there is any holiday, if there is any short-term compensated absence, whether the company should accrue the cost of those compensated absence in the particular quarter or in the particular interim financial reporting period. So standard clearly says that in that case, what we need to do, we need to just apply the guidance of Ind AS 19, which is employee benefit expense. What is employee benefit expense says that if the compensated leaves or compensated absence is a non-accumulating in nature, is a non-accumulating, that it will not be carried forward, right? It will lapse within a particular period. Then the company is not supposed to require or create a provision for those compensated absence. But if let's say those compensated absence are accumulating in nature, that means company can carry forward and utilize, or employee can carry forward or utilize in the subsequent period, in that case company needs to create a provision for those compensated absence. Right, guys? What else? Ind AS 116. Ind AS 116 is the variable lease payment. Right, so under 116 we have read that there can be a variable lease payment. Right, variable lease payment can be which is linked to the index or rate. If the variable lease payment is linked to the index or rate, then it will be recognized as a part of the lease liability. But if the variable lease payment is not linked to the index or rate, then it will be charged to P&L. It will be charged to P&L. So variable lease payment can be linked to the footfall of the consumer to the on the basis of the sale of a particular showroom, right? So those are called the variable lease payment, which are not linked to index or a rate. So in that case, what will happen? So does the company needs to recognize the variable lease payment in the particular quarter? Now in that case, what will happen? So the company has to pay the variable lease payment only when the amount reaches to a particular level or where the sales have been achieved to a particular level. So in that case, the standard says the company need to estimate what is the sale is going to happen in a particular quarter or in a particular year, and basis that the company should recognize the variable lease payment which the company is going to pay. That means company need to estimate what is the sale is going to happen, and whatever the estimates company is doing, that needs to be disclosed in the interim financial statement itself. That is what the meaning and accounting of variable lease payments. Right, guys? Intangible asset, right? Intangible asset means Ind AS 38. So when the recognition criteria which are mentioned under Ind AS 38 get satisfied, only then company needs to recognize intangible, right? So whatever the cost incurred till that particular point in time, all the cost needs to be recognized as a part of intangible. So we need to follow the accounting of Ind AS 38. Right, guys? That cost should not be charged to P&L. That cost which satisfied the criteria of Ind AS 38, that needs to be capitalized, and such cost needs to be amortized in the P&L. Okay, what else? Planned irregular occurring cost. So if there is a planned irregular occurring cost, means the cost which is going to be incurred in the next year, the company has planned on day one itself that this much of the cost is going to be incurred in particular quarter or a particular month, right? So whether the company should recognize the provision of that cost on a day one itself. For example, the company has to give a donation of, let's say, 100 crore rupees in the month of December. So should the company recognize a provision for that donation in the June quarter? Standard says no. The provision of donation should not be recognized in the June quarter. When you incur that cost, only then you have the right to recognize that cost in your books of accounts. That means when the cost incurred, only then you will recognize that cost in your books of accounts. Right, guys? Okay. What else? Income tax. Very, very important. Income tax. Let me write on the board. Let me write on the board in respect of the income tax. Right? Income tax needs to be assessed. Income tax needs to be assessed on the basis of the income, expected income for the entire year. Right? Income tax for interim financial reporting period, how to compute? So it will be computed income tax rate. Income tax rate, how it will be computed? Expected income tax divided by expected income tax divided by expected profits before tax, right? And this will be excluded excluded any gains for which any specific and different tax rate are used, right? Example, capital gain, right? So when I will compute the expected profit before tax, I will exclude the income from capital gain. When I compute the expected income tax, then I will exclude the tax on the capital gain, right? And basis this, I will compute what is the effective income tax rate. This is called effective income tax rate, right? And this effective income tax rate will be applied to the profits earned by the company in a particular period, right? So what is the tax expense? This income tax rate, effective tax rate, will be applied to the income earned in the particular period. So what is the tax expense? Tax expense of interim financial reporting period is equal to income earned in interim financial reporting period multiply by effective tax rate, multiply by the effective tax rate, right? Income tax expense needs to be recognized in interim financial reporting, right? Income tax expense needs to be recognized in interim financial reporting, right? What does it mean? Let me rub this side as well. Okay, example. Let's say this is the quarter Q1, Q2, Q3, and Q4, right? This is the profit or loss, right? Let's say this is a profit of 1 lakh rupees. This is a loss of 30,000, 20,000 loss, right? And this is 50,000 loss. Now in this case, the entire year, there will be zero income. Entire year, there will be zero income. Let's say the tax rate is 30%. Or let's say the tax rate is 20%, right? So what will be the tax expense in this case? So if I compute the effective tax rate, it will comes out to be zero because the total income is zero. But in this case, I need to compute or I need to recognize this tax expense at the rate of 20%. So tax expense will be 20,000 in this particular period, right? In this case, it will be 20% in this particular period. And how it will get reversed? 6,000, 4,000 and 10,000. This will be like this. But the income tax needs to be recognized in the period in which the company has incurred or company has earned the profit. Right, guys? Company has earned the profit. Okay, let's come back And let's take some more example to understand what are the other aspect. Okay, inventories, right? So inventories, if there is any inventory in the internal reporting period, then it needs to be recognized as per Ind AS 2. What Ind AS 2 says, cost or NRV, whichever is lower. What is NRV? NRV is the expected selling price, net realizable price. That means estimated selling price minus estimated cost is the net realizable value. And what is the cost? Cost is the cost of raw material, cost of material, cost of raw material, labor cost, and conversion cost, plus any other directly attributable cost, right? So cost on NRV, whichever is lower, I need to recognize my inventory at that value. Okay. Depreciation and expenses, right? So depreciation and expenses, how should I recognize the depreciation expense? It should be recognized in the same manner in which I recognize in the previous accounting, in the previous full accounting financial year, right? That means I will apply the depreciation either on the straight line method or on the WDV method, the method which I've adopted in the previous annual financial reporting perspective, right? It cannot be the case that if I'm going to purchase the asset in the next quarter, I should be charging today. That is not allowed. It is also not allowed that if I purchase the asset in the particular quarter, I'm charging depreciation in, or I am starting the depreciation on those assets in the next quarter. That is also not allowed, right guys? Okay, foreign currency gain and loss. So if there is any foreign currency gain and loss, that needs to be charged to P&L, right? So if there is any monetary liability, if there is any monetary asset, what is foreign currency monetary asset? For example, foreign currency receivable. What is foreign currency liability? Foreign monetary liability, for example, foreign currency payable. So that needs to be translated as at year end for the rates which are applicable on the every reporting period, right? That needs to be translated, and the differential from the spot rate versus the restated rate will be charged to P&L. So that means the company has to follow the same accounting policies and practice which they have adopted in the previous annual financial statement. Provision. So company needs to recognize a provision if there is an obligation which is arising because of the past event, which results into the outflow of economic resources. Ind AS 37 I need to apply while creating a provision, right? And what is an obligation? As we discussed, obligation can be constructive, obligation can be legal in nature as well, right guys? Let's take a couple of practical example to understand what we have read till now, right? Let's take some practical example. I hope you guys are enjoying. Let me know if there is any doubt on this, guys. Okay, guys. Okay, let's take question number one. Let's take question number one of study material. Let me read. Okay. A company has reported 60,000 rupees as a pre-tax profit, that means profit before tax, in a first quarter, and expect a loss of 15,000 each in the subsequent quarter, right? So this is PBT or loss. Q1, Q2, Q3, and Q4. 60,000 in the first quarter, right? And 15,000 rupees each as a loss in the subsequent quarter. That means there is a net profit of around 15,000, right? This is the net profit, net PBT for the entire year. It has a corporate tax rate of 20%. Tax rate is 20%. On the first 20,000 rupees of annual earning and 40,000 rupees any additional. Okay, so 20,000 rupees on first 20,000 and 40% on balance, right? Right. So now what we need to do, we need to compute what is my effective tax rate. So let's compute what is the, so I need to compute tax and I need to compute PAT, right? So now for computing the tax, I need to compute what is my effective tax rate for the entire year. So how to compute effective tax rate? Effective tax rate is equal to expected tax expense divided by expected income for the entire, for the year. Expected PBT, I would say. Expected PBT for the year, right? What is the expected PBT? What is the expected PBT, guys? It's 15,000. It's 15,000. Right? So this is 15,000 rupees. Right? So what is the tax rate on this 15,000 rupees? So total PBT for the year is 60,000 plus minus 15,000 into 3. So this will be 60,000 minus 45,000 and this will be 15,000, right? And what is the tax? Right? Tax is up to 20,000. Up to 20,000, the tax rate is 20%. So in this case, what is the tax? And next or balance? Balance it will be 40%. So in this case, what will happen? What is this amount is 15,000 only. So I will apply 20%. So what is the tax expense? Tax expense is equal to 15,000 multiplied by 20% is equal to 3,000. Right? So this is my tax expense and this is my PBT. So what is the effective tax rate? 3,000 divided by 15,000, which is approximately 33%, which is approximately 33%. Or let's compute 3,000 divided by 15,000. So this is not, sorry guys, this is not 33%, this is 20%, right? So now this 20% I need to apply here. So 60,000 multiplied by 20%. So this will be 12,000, 15,000 into 20%. Then I need to compute the number, right? 3,000, 3,000 and 3,000. And similarly, I will compute PAT. 60,000 minus 12,000, 48,000. And this will be, add this will be again 12,000 net, 12,000 net and 12,000 net. And this will be total profit. Right, guys? Let me know if there is any doubt on this. Okay, guys, let's move on to the question number 2 of study material. I hope this is clear. Let me rub this. Okay. Please read question number 2. Okay, guys, question number 2. Please read question number 2. ABC Limited manufactures the automobile parts. ABC Limited has shown a net profit of around 20 lakh rupees for the third quarter, right? So net profit for third quarter Q3 for Q3 is 20 lakh, right? The following adjustments are made while computing the net profit. So these are the three adjustments which is given in the question, right? And they are saying these adjustments have already been taken care of while computing this 20 lakh rupees, right? So following adjustments are made. First, bad debt of rupees 1 lakh incurred during the quarter, and 50% of the bad debt have been deferred to the next quarter. So question is saying 1 lakh rupees of the bad debt has been incurred in the quarter 3, but company has deferred 50% of the bad debt in the next quarter. Whether it is allowed? No, it is not actually allowed, right? The cost which has been incurred in a particular quarter or particular period, the cost has been booked in the particular period itself. So what we need to do, we need to deduct additional bad debt, right, which has been deferred. So what I need to do, bad debt debit of rupees 50,000, because already this number has been considered or computed by considering 50,000 rupees of the bad debt. Second, additional depreciation of 4,50,000 resulting from the change in the method of depreciation, right? So additional depreciation has been charged of rupees 4,50,000 rupees, which results into the change in the method of depreciation. Now, do I need to make any adjustment? Because this 4,50,000 rupees has already been adjusted while computing the value of or the profit of 20 lakh rupees, right? So in respect of the depreciation, I will not add or deduct anything, right? Because this is correct. That means the management has taken the correct view or correct decision in respect of doing the accounting of additional charge of depreciation. Next is 5 lakh expenditure on account of administration expense pertaining to third quarter is deferred on the argument that the fourth quarter will have more sales and fourth quarter shall be debited by higher expenditure. So what the question is saying, the question is saying that 5 lakh rupees expenditure has been deferred by the company, right? Because in the next quarter they will have more sale and they will able to adjust this 5 lakh rupees. Is this correct? Answer is no, this is not correct. The company need to incur that cost in the particular period. Company need to recognize that cost in a particular period in which the cost has been incurred. So this admin cost of rupees 5 lakh needs to be recognized. Administration cost of rupees 5 lakh needs to be recognized. What is the correct profit? 15 lakh minus 50,000. 14 lakh 50,000 will be the revised profit. Right, guys? Any doubt, please let me know. Okay guys, let's take a couple of more questions. Right, question number 1 of test your knowledge, practice question. Now we are talking about practice question as well. Right, question number 1. What the question is saying, company expect to earn a 15,000 pre-tax profit PBT for each quarter and as a corporate slab of 20% on first 20,000 rupees and 40,000 rupees on additional earning, right? So company is expecting Q1, Q2, Q3 and Q4 PBT of rupees 15,000. 15, 15 and 15. That means for the entire year it is 60,000 rupees, right? Then we need to compute the tax first, right? And the tax rate is 20% on 20,000 rupees and 40% on the balance. Up to 20,000, it's 20%, and for balance, it is 40%, right? Then how we need to compute the tax, guys, in this case? How we need to compute the tax in this case? So first of all, we need to compute effective tax rate. So let's compute, let's rub this and let's compute what is the effective tax rate, right? How to compute effective tax rate? Effective tax rate is equal to expected tax for year divided by expected PBT for the year, right? Expected PBT is 60,000 rupees, right? And what is the expected tax? Up to 20,000 rupees, the company has to pay 20%, correct? And balance 40,000 rupees, company has to pay tax at the rate of 40%, right? So this will be 4,000 rupees and this will be 16,000 rupees divided by 60,000. So this will be 20,000 divided by 60,000. What is the effective rate? Can you guys compute? 20 divided by 60, 33%. So this will be 33%, 33.13%, 33.33%. This is the effective tax rate, and therefore the company needs to recognize the tax at the rate of 33.33%. So it's almost 4,999. So it almost 5,000. Right? How I have computed? 33.33%. Right? This is equal to 5,000. Correct, guys? And if I need to compute the PAT as well, I hope this is visible. If I need to compute the PAT for this quarter, this is 10,000. This is again 10,000. This is again 10,000, and this is again 10,000, and this will be 40,000. And what is the amount of tax? Tax will be 20,000 only. Right, guys? Please let me know if there is any confusion. Let me repeat this. What I've just done, this is the effective tax rate. Right? expected tax for the year, expected PBT for the year, right? Up to 20,000 rupees, the company has to incur a tax rate of 20%, and after 20,000 rupees, the company has to incur a tax rate of 40%, right? This is the tax rate which is given in the question itself, and this is how we need to compute. Okay, guys, let's take one more question. Okay, let me rub this. Okay, practice question number 2. Let's see. Narayana Limited provides you the following information and ask you to compute or calculate the tax expense for each quarter, assuming that there is no difference between the estimated taxable income and the estimated accounting income. So estimated gross income is 33 lakhs inclusive of estimated capital gain. So that means 33 lakh includes the capital gain, and we have read that when we compute the effective tax rate, we will exclude certain income on which a specific tax rate is applicable, like capital gain tax, right? Estimated income of the quarter has been given. Okay, let me plot this. This is quarter and this is PBT, right? Q1, Q2, Q3 and Q4. What is PBT? 7 lakh rupees, right? Then we have 8 lakh rupees in the quarter 2. Then we have 12 lakh rupees including 8 lakh rupees. 12 lakh rupees, right? Quarter 3 is 12 lakh rupees and this is 6 lakh rupees. And this is including capital gain. So this is capital gain. This is 0, this is 0, this is 8 lakh rupees. This is 0, right? This is 8 lakh. And what about this? 15, 21, 15 or 12, 27 and 33 lakhs, right? Total amount is this, which is inclusive of 8 lakh rupees. So what is the PBT excluding capital gain, right? Why I am excluding? Because a different tax rate is applicable on capital gain. This is 4 lakh, this is 6 lakh, and this will be 33 minus 8, 25. This will be 25 lakhs rupees, right? This is what we have read till now. Tax rate is capital gain will be taxed at the rate of 12%. This will be taxed at the rate of 12%, and income tax will be taxed like for first up to 5 lakh rupees 30%, and balance will be taxed at a rate of 40%, right? On capital gain it is 12%, and tax on the other income is 30% up to 5 lakh rupees, and the balance income is 40% on the balance portion. Now the question is, we need to compute the value or the tax, right? First of all, what we need to do, we need to compute the effective tax rate. So how to compute the effective tax rate? How to compute, guys? Let's see how to compute. Okay, how to compute? Let me compute that. We need to have a tax here, right? Okay, effective tax rate. Effective tax rate. How to compute effective tax rate? Expected tax divided by expected income for the year, or PBT for the year. PBT for the year, and tax will be also be year. And if there is any additional any tax which is not on the income tax, like capital gain, we need to exclude that, right? So how to compute effective tax rate? What is the expected PBT for the year? 25 lakh rupees, right? So we need to compute the income, we need to compute the tax on 25 lakh rupees only, right? So how to compute? Up to 5 lakh rupees, it is 30%. So up to 5 lakh rupees, it is 30%. And balance 20 lakh rupees, it is 40%. Correct? Let's compute. This is 1,50,000. This is 40%. This is 20 lakh, 8 lakh rupees, right? Divided by 25 lakhs. That means 9,50,000 divided by 25 lakh rupees. Now, can you guys compute what is the percentage? 9,50,000 divided by 25 lakh rupees. This is 38%, right? So this is my effective tax rate. So if I need to compute tax on this value and this value, how should I compute? Tax on PBT, excluding capital gain, right? And tax on capital gain, right? Let's compute, guys. 38%, 7 lakh rupees multiply with 38%, 2,66,000, right? 8 lakh rupees multiply by 38%, 3,04,000. 4 lakh rupees into 38%, 1,52,000, 52,000, right? And then we have 6 lakh rupees multiplied by 38%, 2,28,000. What is the total tax on this item? It will be 1,52,000 plus 3,04,000 plus 2,66,000, 9,50,000. And what is the tax on capital gain? 12%. 8 lakh into 12%, 96,000. And what is the total tax? 9,50,000, 10,46,000. Right? This is how we need to compute tax as well. Let me rub this because I need some space. If I need to compute total tax, $2,66,000, then we have 3,04,000, then we have 2,88,000. This will be 10,46,000. And what is the total of this? Right? 1,52,000 plus 96,000. Yes, this will be the answer. Any doubt, any question? So what we have done, guys, first of all, I have separated this column from the normal income portion. right? Why I have separated? I have separated because a additional or a differential tax rate is to be applicable on this income, right? Additional or the differential tax rate is applicable on this income, right? First I have segregated this one, and on the balance portion, I applied effective tax rate, right? How to compute effective tax rate? This is my total income, and this is the tax rate which is applicable to this total income. I have applied these tax on this income, and I've computed the effective tax rate, which is ETR, is equal to 38% in this case, and that ETR is applicable for this, and this is 12%, and basis that I have computed the number. Let me know if there is any confusion in this. Let me know if there is any question in this. Okay, guys, let's read the third question as well. Let's read the third question as well. Okay, let me rub this. Okay, guys, let's read question number 3. An entity reports a quarterly earns 1,50,000 pre-tax profit in the first quarter, but expect a loss of 50,000 in each of the remaining quarter. So that means PBT and loss. Q1 1,50,000, right? Q2 loss of 50,000. Q3 loss of 50,000, and Q4 loss of 50,000, right? That means the total profit is 0. Total profit is 0, right, guys? Okay, let me read further. The entity operates in a jurisdiction in which it is estimated average annual income tax rate is 30%. So tax rate is 30%. Okay, the management believes that since the entity has a zero income for the year, its income tax expense for the year will be zero, right? Management is of the view that the entire income tax should be zero because the profit for the income for the profit for the entire year should be is zero actually. State whether the management view are correct or not. If not, then calculate the tax expense for each quarter as well as for the year as per Ind AS 34, right? So what we need to apply, so what we have read in respect of tax expense, that the tax expense needs to be recognized on the basis of the effective tax rate. If there is any profit, we need to recognize a tax expense, right? In this case, the effective tax rate is actually coming to 0, right? So we need to apply this tax rate in this particular period. So that means 1,50,000 multiplied by 30%, which is 45,000, right? And similarly, there will be a tax credit, tax expense, and this will be a credit, right? 50,000 multiplied by 30%. is equal to 15,000. Same amount, same amount, right? But there will be a tax in a particular quarter. There will be a tax in a particular quarter. Right, guys? Okay. Let's talk about a scenario. If there is a restatement of interim financial reporting. If there is a restatement of the interim financial reporting, right? So in this case, what will happen? The company needs to apply same accounting policies which company has applied adopted in its previous annual financial statement. That means company has to apply Ind AS, Ind AS 8, right? What is Ind AS 8? Ind AS 8 says that the previous period will be restated. Previous period will be restated if a change in accounting policies, right? B, material prior period, and C, reclassification, right? And fourth is common control transaction, right? So if there is any change in the accounting policy, if there is any material prior period item, if there is any reclassification, and if there is a common control transaction, then the previous period will be restated. And company needs to apply Ind AS 8. The company need to apply Ind AS 8 standard, which the company must have applied in the previous full annual financial statement itself. Right, guys? So this is the guidance on the restatement of interim financial reporting period. One more aspect is left in respect of first time adoption, right? In respect of first time adoption. First time adoption. That means Ind AS 101. First, no exemption and exception exist in respect of Ind AS 34. That means Ind AS 34 is applicable retrospectively. right? What all reconciliation needs to be presented, right? Equity reconciliation to be presented. Equity reconciliation equity reconciliation for the transition date and comparative reporting date, right? Profit reconciliation for comparative period, right? And third is statement of changes in cash flow for comparative period. Instead of statement, I should say reconciliation, right? So this will be the guidance. This will be the guidance in respect of the first time adoption, that first of all, no exemption and the exception exist. That means Ind AS 34 is applicable retrospectively, right? In case of the first time adopter, company has to give two equity reconciliation. One is on the transition date, one is on the comparative date. Profit reconciliation needs to be given, which is only for the comparative period, and changes in the cash flow needs to be reported as compared to previous gap, right? This is in respect of Ind AS 101. Let me talk about in respect of in respect of uh, disclosure. What are the of disclosure requirements of Ind AS 34? Right? Let me blow up my screen. Okay. Disclosure. Let me select the pointer first. Okay. The entity shall disclose the following: statement on changes in the accounting policy and the method of computation or changes in the accounting policy needs to be disclosed. That means if there is a change in the accounting policies as compared to the previous period, that needs to be disclosed. Explanatory comments about the seasonality and the cyclicality of interim operation, that needs to be disclosed. Change in the estimates needs to be disclosed. Unusual item, nature and the amount of the unusual item to be disclosed. Issues, repurchase, repayment of debt and equity securities, that means equity infusion, issuance of debenture, that needs to be disclosed. That means these are the critical transaction or the significant transaction. Dividend paid to be disclosed. Operating segment to be disclosed. Material subsequent events to be disclosed. Changes in contingent asset and liability to be disclosed. Fair value of disclosure of the financial instrument to be disclosed in the interim financial reporting period. Then changes in the composition of the entity. Business combination to be disclosed. Gaining or losing control of the subsidiaries and the long-term investment, that needs to be disclosed. Restructuring and the discontinued operation, that needs to be disclosed as well. Any transaction and the event that may be material to the understanding of the interim period, that needs to be disclosed as well. What are those items? This we have already discussed. Inventory write down, inventory reversal, inventory write down, inventory reversal to be disclosed. Impairment loss on the financial asset, impairment loss on the non-financial asset needs to be disclosed. Any impairment triggering event occurs in the interim period to be disclosed. Acquisition, disposal, purchase commitment to be disclosed. Litigation settlement to be disclosed separately. Loan agreement, breaches, default, and the related party transaction needs to be disclosed separately, guys. So there are the disclosure. If I need to summarize the entire disclosure, it's only one thing: significant event and the transaction needs to be disclosed. What all needs to be disclosed? Balance sheet, P&L, statement of changes in equity, cash flows, right? What else? Estimates and judgment, and the significant event, all the significant events which happened in that particular period needs to be disclosed. And if there is any subsequent event which has happened, which is significant, that needs to be disclosed as well, right? So guys, this is in respect of Ind AS 34. This is a simple and a small standard. Request you to please go through it, and thank you very much guys for your patience. Thank you guys.